Hi, everyone. John Boardman, founder and CEO of Ballast. We appreciate you joining us today. Today is January 22nd, 2021, and we are 2 days past the inauguration, and we thought it would be a wonderful time to record a podcast of some of our thoughts looking at the remainder of this year. Now that the calendar is turned, we're still dealing with many of the issues that we had in 2020, although many of us were hoping that 2021 would look completely different. At least it's starting very similarly to the way that it ended it. So we just wanted to go around the room and get everyone's thoughts on what they're looking at and talking to clients about starting this calendar year. We want to be forward looking. I think we've always tried to take a very long-term perspective for our clients, which from an investment standpoint is typically the best thing you can do. We also try to not be too political for two reasons. One, can't really say anything these days without offending someone, but more importantly, it's really not our job to be political. We have to deal with the conditions, the policy conditions that we're in. And I think if we try to make decisions in consideration of our own political beliefs, it might take us through a filter that might lead us to improper decision making for our clients. So that's the stance we take as a group, and I think it's proven over the years to be beneficial to our clients. So I want to go ahead and get started. I'm going to start with Brian, and first I want to introduce everybody. Actually, I've got Andy Reynolds, who is our partner, chief operating officer, and financial advocate. Brian Burton, who is a partner and director of portfolio strategy. Cameron Hamilton, who is a partner and director of financial planning, and Frank Yoswick, who is our director of estate planning and tax. So we'll get perspectives from everyone on a number of different topics today, and we'll keep this swift as we address a number of topics today. So Brian, I'm going to go ahead and start with you. Markets had a fairly wild 2020. Pretty remarkable looking at how the markets ended and thinking back to where it was, 9 months prior. What do you attribute the activity of 2022?
Yeah, John, the old adage that the stock market is not the economy has never rang more true than it did in 2020. If you just look at the Russell 2000 index, which is a measure of U.S. small cap companies, that index was down, nearly 40% year to date in the middle of March, and ended the year actually up 18%. So an incredible recovery in just 9 months' time. People talk about disconnect between the economy and markets. Just looking at small cap companies, you had an index up 18%, while the number of small businesses in the U.S. plunged by 25%. So really an incredible recovery from the markets. So many negative headlines throughout the year, hundreds of thousands of deaths from COVID-19. You mentioned politics, obviously a very deep political divide in this country, but the mood on Wall Street, very much upbeat from second quarter on throughout the year, and at times almost euphoric. It's amazing how the market can ignore the dystopian present and just fast forward to a utopian future. And that's what markets tend to do. And that's what we saw in 2020. There were some good solid reasons, though, why markets rallied as swiftly as they did off the lows. We had unprecedented monetary and fiscal stimulus. So we had bond purchases, massive bond purchases by the Fed. You had direct payments to individuals and families, and you had forgivable loans to small businesses. So just a ton of money flowing into the economy when it was most needed. And with that, markets are convinced that the Federal Reserve will take immediate, swift action at any hint of an economic downturn. So the Fed backstop is there. It's very much powerful. Markets love certainty, and they feel right now that the Fed being there is a certainty. Inflation has continued to remain low. It's a positive for equity markets. And although low interest rates are a negative for fixed income investors, it continues to be a boon for the stock market. The acronym TINA, which is there is no alternative, is very much alive and well in this time. That's why we continue to see a lot of inflows into equity markets.
I think something else to add on to that as well, Brian, is, we've seen a really segmented impact of this pandemic. And, when you start looking at GDP and you start looking at profitability of some of these companies that may not have been in the entertainment or the food industry, some of them have done really, really well. Speaking with small business owners here locally, we have several small business owners that had one of their best years ever this year. So, people are spending money still. It's just looking a little bit different. And to your point about the stimulus, they're also getting a little bit more money to spend. And if they happen to not be in some of those industries that were significantly impacted, they may have actually had one of their better years ever.
Yeah, I mean, if we think about the stimulus package, as Brian referenced, and the size of it, the magnitude of it, people punch holes in every policy, that Washington puts out. But in retrospect, it was wildly successful. I mean, to be able to get money out that quickly to business owners, many of which who were probably considering closing temporarily or permanently in the middle of that, it was a pretty remarkable feat. Of course, there were inefficiencies and people got money who probably didn't need it, but it got to the people that did need it for the most part. If I recall, the second round of PPP funding, it actually took a while to fully be used up. If it wasn't, there may have even been some left over at the very end. I mean, it was a pretty remarkable tool that was put in place, and obviously we've got another one coming up now. Andy, let's go to you. Getting a lot of questions about some of the high flying names that are in the markets these days and the stories of these companies. So the natural question is, are we in a bubble? Or is the market in a bubble? Is this something we need to run away from?
Yeah, I think it's something we need to be very cognizant about, and we need to really think through how that is impacted. Are we in a bubble? Perhaps. We would be ignorant, I think, to ignore that potential. Valuations will matter at some point. You start looking at these PE ratios of companies, even our big tech companies that ran with relatively low PE ratios for a while, and they've just skyrocketed. Those will matter at some point. Is that in the next 6 months? I don't know. Maybe it takes long enough to where the companies can raise revenue and the PE ratio just naturally comes down. Nobody knows when a bubble actually is going to occur. And even if you are in a bubble, whether or not it will burst. So, I think the other thing that we also have to be aware of is just interest rates and kind of that TINA word. What else are you going to do with your money right now? There's not a great place to put money other than the equity markets, just with interest rates being so low and potentially rising, and potentially inflation on the back end of that. There's a lot of tailwinds for the equity market. So, more likely than a bubble bursting, what probably we see is new flows of money going into some of those more attractively valued companies, those deep value names. I think both can do well over the midterm, but you may see a better return of the companies where the PE ratio makes a little bit more sense. We also just have to recognize that some of these companies have come from nowhere, and the pandemic has expedited that change. You talk about Zoom, what we're on right now. You go back 18 months from now, and how many people would have had a clue how to get on Zoom? So it's forced an expedited change that was coming, and no one knows how that plays out. I can promise you that 18 months ago, I don't think we were Zooming with any clients. And 18 months from now, we probably will still have several Zoom meetings, hopefully a whole lot less than we have now. But I think this technology and many other things is embraced and it's here to stay. So those PE ratios, while they may seem exorbitant now and way out of line, the growth could grow into them to make them a little bit more palatable.
Yeah, good point. We don't have to look that far to find examples of companies that traded at exorbitant PE ratios that ended up crashing down, and others that grew into the expectations that Wall Street and investors had for it. So it's really interesting thinking about how Wall Street maybe looks at one industry or a specific company versus another, and really has sort of different standards by which they're judged.
Yeah, and the biggest question is, so I guess the bubble question. I mean, we have to say yes, we're in something. The question is, how do you get out of it? Is it a burst to where we come crashing down, or is it a pause to where the stock price stays stagnant for a period of time and allows the revenue to catch up to make it look a little bit more reasonable and in line with what you traditionally expect?
Good point.
Is it general, or is it more sector specific for some of these names that have run up? Because we've seen kind of a renaissance in value early on this year. So I'm kind of, my opinion is towards the latter, hopefully.
Yeah, there's a lot of impacts that are affecting that. Index investing is I think a big tailwind for these PE ratios. But yeah, I think there will be a day where we all wake up and we say, oh my goodness, this stock that's in this index, its PE ratio is nowhere near what it should be, and money floods into that. The question is where it comes from. Is it new money, or is it money that very quickly left these high flyers?
The stimulus that paid out, they said not coincidentally, Robinhood had a lot of transactions around the very same value, the dollar value, I should say, of those stimulus payments. So sort of interesting. Probably a better use than just going out and spending it, although I think the intent was to go out and spend it from the government.
Right.
Yeah, I mean, I don't want to downplay the risk that is posed at this point with valuations where they are, but don't forget that Amazon in 2012 traded at a 3,600 PE, and the stock was at $250 a share. So not to say any of these companies are Amazon, but
yeah, it's a good point. That's a very good point. Cam, let's turn to sort of looking at not politics necessarily, but we do have a new administration. We've seen some executive orders already in the first couple of days. But what about legislation? You're our resident financial planning guru, and so a lot of these potentially policy changes, tax changes could impact the planning that you orchestrate. What are you paying closest attention to?
Yeah, well, I think we're going to have to get a little bit political here, but I think it's really just about us reading the tea leaves on the environment. The first thing I'll say is, in general, I think markets tend to like a divided government, just because that lends itself to gridlock. And I think that's what a lot of people thought was going to happen in Q4. Those Georgia races flipped it to a very narrow majority. So essentially we're as close as we can be to a divided government. So that means that Congress is going to have to, is not going to be able to ram through, the more extreme policies from the left. I think there's going to be need to be some cooperation. So early on, I'm going to be watching how the first COVID relief plan comes together and what type of cooperation there is there. So there's been talk of new direct payments to citizens, extending unemployment, whether there's child tax credit, state aid. That'll show a good marker for what type of cooperation there is. And I think that kind of sets the stage for if there's any type of signature legislation that comes up, it's going to take cooperation. So I think the one that everyone has their minds on is tax reform. There was tax reform at the end of 2017 in the last administration. And is it just a complete remaking? My personal belief is, some of the more extreme proposals that were made during the election won't come to fruition. So they say you get elected on the edges, but then you have to govern through the middle. And that's kind of already what I'm seeing. So I think we can expect changes. The top marginal tax bracket, I really expect to increase, maybe back to 39.6, something like that. Corporate tax rates going up to a higher level that's intermediate from the low 21% we have. I've seen 28 thrown out there, which would be lower than 10 years ago, but higher than today. But as far as like more extreme measures that would remake the tax system, long-term capital gains rates being really preferential at 15 to 20% right now, going back to ordinary income, it really doesn't look like there's the support there to happen. So, but that brings up a lot of planning opportunities. And the good thing is, I think we're always thinking with our clients very long-term and trying to design a balance sheet that can be successful in any number of situations. So I tell people I'm expecting tax rates to go up over time. Budget-wise, that's the only place that makes sense. So we do a lot of things with Roth. We're big champions of Roth that I think if there is increased taxes, our clients will benefit from kind of our thesis on that we've had to date. But, I think really it's just about moderation of policies. One of the things during the election was cancellation of student debt, you hear. I don't think there's a wholesale cancellation. I'm seeing proposals like, well, we'll do income-based, and then if someone's on that plan for 20 years and it gets forgiven, it won't be taxable. So that's a dramatic moderation from some of the proposals we were seeing a year and a half ago by people trying to get a nomination. So that's what I'm hoping for. But either way, we're going to plan around it with our clients, no matter what comes to fruition.
I think one thing just to quickly add is we sent out a commentary in November, right before the election, with some studies that Fidelity and American Funds did, going back and just kind of talking about a new administration. The markets do well in any combination of leadership and relatively similarly well. So that's going through tax changes, going through crises, going through wars, going through all kinds of different things. So I think that's one thing to Cam's point. We got to have a long-term perspective, and we are very divided right now. And we've had phone calls from both sides saying no matter what happens, the world's ending. And I don't think that's happening. And history would show us that, going back to kind of what we are, we survive and we move on. And the market can do well and the economy can do well no matter who's in leadership. It's hard to, as Cam was saying, make big sweeping changes. You govern in the middle.
Yeah, I don't think it's good for investors long term. I don't think it's good for confidence long term or political division long term for us today. Every 4 or 8 years have this sort of tidal wave of policy that completely reverses what the previous administration put in place. I think Wall Street investors, markets, most importantly, respond best to less activity and sort of letting companies operate. How difficult is it for a large multinational company to plan 5 and 10 years ahead if they don't know what the environment's going to look like? And so I think that will be something to closely watch. I did want to touch on interest rates, which a couple people have mentioned, and I'll say something briefly and anyone else chime in too. We've had a lot of questions about rates being so low. It's been, just an absurdly great opportunity for people to refinance multiple times over the last 10 years. Just when we think we've hit a new low in rates, we find another new low. And, now, you have people refinancing, 15-year loans at under, 2%. We talked to someone the other day, and 30-year under 3%. Just remarkably low rates. Great for those people who are borrowers. Not so great for fixed income investors, people that have cash. That environment appears to be in place for a while, has been in place for a while. But the question is that a good thing or a bad thing? I think it's a good thing in the temporary for borrowers, and obviously not so much for savers. But in the long run, it's something that, it could create some issues. It is lending money to someone for 30 years at under 3% per year a proper measurement of the risk that the lender is taking on. I would argue it's not. And it's sort of been a supplemented lending structure that we've been in for the last bit, since the Fed's gotten so involved in trying to keep rates as low as possible for so long. That hopefully will play itself out methodically, and we won't see rates come up very quickly. But if we did, that could be a real shock to the system. I think we'd have to see inflation. And the one thing the Fed has really, I think, celebrated and surprisingly celebrated is the fact that inflation has not reared its head like it was expected to. It would have been hard to argue, if we look at, rates have technically been coming down for over 40 years, but if we look at the last decade specifically, more than that, really looking back to when it all started in the financial crisis, when it really went low, it would be hard to argue that we wouldn't see some meaningful amount of inflation at this point. And wages just have not crept up. There's a lot of structural things that probably are lending to that we could talk about on a future podcast. But so far, the Fed's benefiting from that. And it's allowed them to stay patient with easy money policy for a longer period of time. And Jerome Powell confirmed that when he spoke last week. Anyone else have any thoughts on rates?
Yeah, John, it's a very hot topic, and as it should be. And, my biggest concern with rates, and I think, one of the toughest things that the Fed has on their plate is how can they ever lift rates off of these extremely low levels? If you look at the housing market currently, there's already too many dollars chasing too few homes. And if rates all of a sudden go up, people are probably paying more for homes than what they're worth already. If you see rates tick up, even to 4, I think you get a gridlock in the housing industry. People become upside down on their mortgages very quickly. So it's going to be a difficult situation for the Fed to ever move rates off of these levels. I think they need to. I hope it's done in a very methodical, slow, well thought out manner.
And a little bit, they painted themselves into a corner because we've been so low. And so then they went to, forward projections saying we're going to keep it low. And now we've kind of added or changed the philosophy on when the rate increases need to start. So that, like John was saying, Jay Powell coming out and saying that inflation can run above 2% for a moderate amount of time, which we can parse the words on that, but they're indicating that not anytime soon.
Sometimes I feel like our conversations are like Groundhog Day. For the past decade, anybody who's been working with us that long, almost every meeting, we got to be cognizant when rates rise. So, I think it's going to be a whole lot harder than anybody gives it credit for to actually do it, unless you just bust through raising rates, and that's where the real damage could occur, as you're saying, Brian. So it does feel like a repetitive story that has not changed in over a decade.
Yeah. So the moral of the story is, if you're refinancing, go from a 30 to a 15-year. Do something productive.
Yeah.
Don't just free cash.
Yeah. Good point. It's going to have to be a global shift. It's almost going to have to be in unison.
Mm-hmm.
Otherwise, you've got countries that are, if they remain negative, 0 rates, and the U.S. even ticks up to 1.5, money's going to flood into the U.S. Treasuries, and rates are going to remain, depressed. So,
absolutely. Frank, let's pivot to you. Like I said, 2021, we hoped, New Year's Eve was going to be the last day we'd be dealing with COVID, and we're 22 days into the new year, and it's still a big concern. At some point, COVID will be in our rearview mirror. What do you think the economy is going to look like as that happens, or after that happens?
Well, I know we've all got our fingers crossed that that day comes sooner than later. I think everybody's ready to go back to quote unquote normal, whatever that's going to be. And that's kind of what I think the theme is going to be, at least in the immediate short term, is pent up demand. As people get more comfortable going back to normal and as restrictions are lifted, I think we're going to see restaurants and bars getting a big boom, even if they're open now at a lower capacity. And once they're open to full capacity, once people get more comfortable with going out in the post-COVID world and the vaccines are readily available, you get more servers and bartenders back to work. I think you're going to see the same thing in the travel and the hospitality and the entertainment sectors. So you've got a group of people who did not lose their job, who did not lose their income, who have money to spend and a demand to go places. They have a demand to go travel and go on vacations and get back down to Disney World and spend money. And then you've got the people who work in those industries who were impacted by the shutdown. They're going to be earning again. They're going to get back to having their regular jobs again. I think a little bit later in that same vein, you're going to see conferences and trade shows getting back up and running. And again, that's going to have an impact on the airlines, the hotels, the restaurants and bars, and all the service industries around all that. Just people traveling for fun and mass groups of people traveling for businesses and trade shows. I think in our local economies, you're going to see the mom and pop, the brick and mortar retails getting back up, getting a little boost as well. For the past year, everybody's kind of gotten used to buying everything on Amazon and buying everything online. But again, once we get comfortable again in the post-COVID world, we're going to be more people spending money back in our own communities again. I think we're going to see the non-essential small businesses, the manufacturing jobs that were quote unquote non-essential, going back to work. Some of those companies now, as you all were just talking about, with rates being low, that can be a positive for those companies now that they can go borrow money cheaply and expand and grow their operations. With the whole world being involved with the small businesses, global supply chains reopening back up as other countries get back to their normal as well. So it's not going to affect manufacturing as much here in America anymore. Once those supply chains are back open everywhere and goods are flying across borders, more back to normal. So again, as businesses open back up, as patrons are start frequenting those businesses more, you get more money, more wages to the waiters and the bartenders and the employees in those jobs. More money going into the economy, more people can spend again. I think some things that we may be looking at permanent changes. Housing, as you all touched on again, with rates being so low, people are buying new houses at record levels, it almost seems like. And during the shutdown, we saw companies like Home Depot and Lowe's have great years. It kind of makes sense. A lot of people sitting at home looking at that room that otherwise they would have been at work, but now all of a sudden they want to remodel that room that they've been looking at for the last 9 months. So that makes sense there for the Home Depots and the Lowe's. But, we've also seen this exodus from big cities into the suburbs. And if that is a large enough change and a permanent enough change, that could really have a major impact on the local economies of those larger cities around the country that may not be the same anymore, with people wanting to spread out and have their own space and not be literally on top of each other going forward. I think in some industries, we could actually see the shift away from global supply chains and more towards sourcing materials locally. This is going to, avoid issues if there's another global pandemic or another global equivalent issue that shuts down a global supply chain. Some of those companies are going to say, hey, we want to be ready for that and not have to rely on getting our raw materials from another country. So we could see the change in the economy that way. I think many businesses over this past year have been forced to work remotely. We can see the permanent shift towards working at home. We can see a decline in the demand for commercial real estate in downtown areas. We in our business have had a heavier reliance on technology, and we're not alone. A lot of businesses have had to higher reliance on technology like Zoom and cloud-based technologies. So again, those technologies and companies are poised to continue to make big gains. I think some industries as well, you're going to see a downsize in labor. You're going to see a substitution of capital for labor. So for example, if you have a large manufacturing company that's heavily reliant on human labor, Well, now they see that they're vulnerable to a disruption by a virus. Going forward, they may shift more towards robotics. So it could be even an overall lower cost for the company, high upfront cost, but going forward, less payroll, less health insurance, retirement plans, and workers' comp, et cetera. So in a way, I guess good for the company, but the downside of that then is less people employed in the labor. So in the short term, I think we're going to see a boom for small businesses and local economies driven by just this pent-up demand and government stimulus. And in the longer term, maybe some more permanent changes due to the technology was always on the horizon. But to Andy's point earlier, this situation really accelerated that process and cemented some things that maybe fewer years than otherwise would have occurred.
Absolutely. Yeah, I think, when I think about the economy and, what it's going to look like, and I think there is a lot of optimism in this sort of post-COVID world, the scar tissue that might be there that we're not anticipating, in some of these businesses and banks, for instance. I mean, there's just a lot that will reveal itself, that will surprise us, some positive surprises and also some negatives to come with it. I think that's what this year will be about. So I'm going to go around the room. We'll kind of close on this last couple of questions before Andy actually gives us some thoughts kind of overall on what clients need to be thinking about for the calendar year. Headwinds. Let's do the negative first, and then we'll end on a positive. Looking at the next year, several years, Cameron, we'll start with you. What headwinds do you see economies, markets, investors facing?
Yeah, don't shoot the messenger on this one. In the past, I've been a big believer that the one that got us this time isn't going to be the one that gets us next time. It's going to come out of left field. But in this case, I think we have to say COVID is going to be a big headwind, U.S. globally next year to 3 years. I think the markets are pricing in a good vaccine rollout that has proved to be slower than many people had hoped. We're hearing about viral mutations that so far, knock on wood, vaccines are taken care of, but who knows there. This is a disease, coronavirus, just like the common cold, that it could be an annual thing. So, I hope that it's not a malaise on our economy dealing with this every year, and that we can nip it in the bud, so to speak, but that might not prove to be the case. So I think it's a big headwind.
Brian, what about you?
Yeah, I'll focus more on the markets. I think, your big pandemic winners, so your tech, e-commerce, home delivery companies, I think they've done so well right in 2020. I think they're going to face very tough earnings comparisons in 2021 and beyond. And some of those companies, particularly big tech, make up such a large percentage of the S&P 500 or whatever index you're looking at, that could be a headwind for markets overall.
All right, Frank.
I think it's going to be it may be a little counterintuitively, but technology and jobs, the acceleration of technology development and adoption, I think it's going to replace a lot of your assembly line type workers with technology and robotics. And that could, down the road, exacerbate the separation of wealth between the haves and the have-nots of who gets to keep their job and who doesn't.
Good point. Andy?
We're going to have to look in the mirror at some point and ask the question, are we at artificial levels? If you think about what we've gone through recently, we've created a whole new set of debt. We're going to have at some point a tapering of stimulus. We have low rate levels that have been set. We've also seen just generosity in the U.S. population that we typically won't see and will wear off at some point. So we're going to have to look in the mirror and see if we can stand on our own 2 feet at some point. When that is, I don't know, but we can all agree that there is some degree of stimulus we're all sitting on top of in the market, and the economy sitting on top of right now. We gotta get off it at some point.
And I'll just add sort of the backdrop of political division that is still there and just seems to be further emboldened every year. And I think the blame there are a lot of people to blame. I mean, it could be leadership in both parties. It could be media. It could be whoever you want to blame. There are a lot of people, I think, that created this situation. But we are in a world today where people are sort of buying into two different sets of facts and information, and that makes it very difficult for any amount of negotiation or sort of meeting in some sort of a moderate solution. So I hope that washes away to some degree, but there are no signs at this point that political division is going away anytime soon. So let's end on some happier stuff. Tailwinds. Cam, start with you.
Yeah, I think, I can shout USA here. I think we're still the home to innovation. Last year, Pfizer and Moderna were great examples of that, we are the leaders in the knowledge and service economy that the world is moving towards. We're still the number one place to invest. U.S. Treasuries are still the risk-free investment globally. We're still over half of the global equity market. So I think that's a tailwind to remain in leadership.
Brian?
Yeah, I would say hopefully with widespread vaccinations by, Q2 of this year, all the activities that were put off in the stay-at-home environment should hopefully resume. I think there's a great deal of demand there. And it's not hard to imagine a Q3 and Q4 of this year that look more like 2019 than they do 2020. So hopeful there with vaccinations that we get our economy back to where it was prior to this pandemic.
Frank?
I think it's pent up demand. I think a lot of people are ready to get back to a normal, and a lot of people are ready to get back to just going back out and spending and participating in the economy and restarting their businesses and opening their doors again. And a little bit of an echo on what Cam said with USA. I truly believe in the American spirit and people, rallying after a negative event like this and really coming together and moving forward in a positive way.
Andy?
Low rates. It's a two-sided coin. It's a headwind and a tailwind. It's the lever that I think has pushed us to where we are today, from being able to go out and borrow and spend, and then also pushing money into the equity markets. So, the Fed's come out and said they intend to keep them low for a while. I don't anticipate those significantly going up over the next 12 months. So I think that'll continue to be a driver of economic growth and equity growth over the next 12 months.
Yeah, I'll just add, and we've said this before, to be a long-term investor, you have to have some amount of faith in mankind to innovate through challenging times. If you look back over the history of this country, specifically, some of the largest companies that exist today in the world were started in some of the deepest of recessions. If we look back over the last 12 months, think of the innovation that businesses, large and small, have created and really advanced their business in so many ways in the face of really, horrifying conditions. So I think entrepreneurship is encouraged today in our youth, and I think it will continue to be something that people aspire to create and start businesses. And I think that gives all of us a lot of optimism in where this country can go and how investors could benefit from that. So Andy, I want to go ahead and hand it to you and let you bring us home.
Yeah, so just a sincere thank you to everybody who's watched this, and to our clients who've stuck with us through the past 12 months. I think, as we put in our quarterly letter, it's been one of the most humbling times of our careers. And as we had time to reflect on the chair that we sit in and what we do, it's an honor that we truly feel for every single one of you. So thank you for that continued support. We're also, as we said, pleased to say that we didn't have a single client make an irrational decision. And that's a testament to all of our clients who work with us, and hearing the words that we share and and believing in our philosophy. I think 2020 is better than any other year, prove that the way we're doing things is the right way to do it, and it's working well. I think it's important in times like these to, from a market standpoint, a portfolio standpoint, and looking at your personal finances and your balance sheet, just remember to remain disciplined and not to become complacent. For making good decisions in good times allows us to be prudent and allows us to stick to a plan in bad times. So as we've said, back in the spring, don't overreact and get too conservative. When we're looking at markets like we're seeing today, don't get complacent and get too greedy either. So it's a great time to take a step back and look at things for your own plans. And I just wanted to kind of finish with it's this time of year that we typically go to a conference as a team. And it's something I think I'll speak for all of us. We look forward to, and we all generally like each other. And Frank made a comment about, at least I like you guys. You guys, I see some of you smiling. I think Frank made a comment about conferences, and as we get through this time of this pandemic, it's something it's not just people and their friends and family and whatnot that they're longing for, but I think there will be a desire just in business too to go do those things that you enjoy, and spending time with your colleagues and spending time just getting back to a normal life. And I think that's a huge tailwind for just the economy and the markets. And 2020, I don't think was a fun year for anybody, but it will end. We'll get through it. And I think there's a bright future to come. So thank you for everybody who's stuck with us through this crazy time. I think there's only better things to come.